Right now, the stock market is experiencing a massive identity crisis. We are either in the middle of a generational boom or a total collapse. This line chart tracks cash flow multipliers of traditional software companies, whose valuations have been cut in half recently. But right next door, companies building AI and hardware are skyrocketing, adding billions in market cap almost overnight. This explosion is built on physical chips produced by companies like NVIDIA, led by Jensen Huang, providing the computational horsepower required for these massive models. Investors are doing the math. If an AI can generate complex digital products instantly at zero marginal cost, traditional software moats disappear. Wall Street is violently reevaluating what a tech business is actually worth when code becomes a cheap commodity. The frontier labs driving this shift are locked in a fierce arms race. Heavyweights like OpenAI, led by Sam Altman, are scaling increasingly complex models. This acceleration is powered by vibe coding. A single person can now prompt an AI agent to build a functional app in a weekend, replacing the budget and timeline of an entire traditional development team. These agentic systems take direct control of the operating system. They navigate desktops, move the cursor, and bridge the gap between separate applications to finish tasks without human intervention. Capital is rushing out of traditional software and into frontier models. Investors are chasing infinite digital abundance, where human labor no longer bottlenecks production. But there is a hard limit to this digital expansion. You cannot vibe code a physical house. An AI agent cannot spontaneously generate a global supply chain out of thin air. To see the cracks in the physical economy, we look at the financial data. Analysts like Steve Eisman point to quiet but serious distress signals. In the private credit market, major funds from firms like Apollo and Ares have started capping investor redemptions. When investors ask for their money back, the funds are only honoring a small percentage of those requests. Lenders are tightening their underwriting standards and restricting credit. Add in geopolitical conflicts disrupting global supply routes, and the cost of moving atoms instead of bits is climbing fast. While the digital world scales infinitely with artificial intelligence, the physical world is slamming into a brick wall of expensive capital, logistical friction, and absolute scarcity. There is no better example of physical scarcity than the American housing market. Massive demand collides directly with a frozen supply of existing homes. But the primary bottleneck stopping builders from flooding the market with affordable homes isn't a shortage of lumber or plumbers. It is local regulatory bureaucracy. This chart deconstructs a new home's cost. Municipalities charge up to $150,000 in permitting fees just to break ground. Eating this massive fixed cost crushes the profit margin for affordable housing, forcing builders to construct expensive, large footprint houses just to recoup their investment. The contrast is sharp. The digital economy is racing towards zero marginal cost and infinite scale, while the physical economy suffocates under local red tape and gridlock. We're now operating in a bifurcated economy, split between two entirely different sets of rules. The digital world is facing massive legal vulnerabilities. Tech giants are getting hit by the tort tax, facing multi-billion-dollar liability lawsuits over the mental health impacts and addictive algorithms of their social media platforms. Meanwhile, the physical world has an existential priority of its own, a high-stakes industrial and scientific race against China. Government councils are heavily focused on securing physical supply chains, advanced manufacturing, and biotechnology. This national push for industrial self-reliance highlights a different kind of value. Investors are moving towards high-asset, low-obsolescence businesses, or HALO assets. These are physical companies, like home builders, that trade below the value of their actual property and remain shielded from AI disruption. Surviving this market reset requires recognizing a simple truth. The most durable value over the next decade will be found in physical scarcity that digital abundance can optimize but never replace. Navigating this chaos requires tracking the total market temperature, so you don't overpay for AI hype while ignoring underpriced physical assets. To track these exact macroeconomic valuations, search for and download the Buffett Indicator app from the Apple App Store. As a reminder, all analysis is based on publicly available sources. This channel is for educational and research purposes only and does not constitute investment advice. Always conduct your own due diligence. For more advanced research and access to our multi-agent AI tools, join the community at deepvalues.ai and subscribe to our sister channel at Deep Values. Finally, drop a like on this video to appease the algorithmic superintelligence. Thanks for watching, and we'll see you in the next one.